Hey guys, what's up? Welcome back to my financial focus. In today's video, I'm going to be doing an intrinsic value analysis of the business Netflix. Pretty popular business. It's one of the world's leading entertainment services. They've got approximately like 204 million paid memberships in over 190 different countries. And tomorrow, on January 20th, 2022, they are going to be announcing their earnings, and the estimated earnings per share is expected to be around 82 cents per share. So in this video, I'm just going to go over their business model, how they make money, what it is they do, some of their expenses, and then I'm also going to identify one of the primary risks that is facing Netflix, facing their growth in the future. And then I'm also going to go over their financial statements to see what the financial health of the business is. And then lastly, I'm going to do a discounted cash flow analysis to figure out what a good buying price would be from a value investing perspective. So thanks in advance for leaving a like, and let's get right into it. So first and foremost, like I said, Netflix is the leading entertainment service in the world, or one of the leading entertainment services in the world. They provide different TV shows and documentaries spanning a wide variety of different genres and languages in different countries. And then they also offer a less popular DVD by mail service only in the United States. And then if we go into their annual report here, we can see, if I scroll down to page 3 or page 4 right here, we see that they have, as of December 31st, 2020, about 9,400 full-time employees located globally in 59 different countries. About 81% of them are in the United States, and the rest of them are spread out across Europe, the Middle East, Africa, and in the Asia Pacific. And these employees are basically responsible for content production, so things like Stranger Things or other shows like Black Mirror and things like that. And lastly, in terms of their business model, they generate almost all of their revenues, as we'll see later on by looking at their financial statements, from their subscription-based model, primarily just through selling monthly membership fees for the services for their content. If I go to page 22, that's the first page where we're going to be looking at one of their financial statements. This is just a consolidated statement of operations, and we can see their revenues over the last couple of years have steadily been increasing from about $8.8 billion in 2016 to $24.9 billion in 2020. And their net income is equal to a little less than about 10% of their total revenues. So their net income for 2020 came out to be about $2.7 billion. And we can see that there is a pretty big jump in revenue from 2019 to the year ending in 2020. And that primarily came as a result of the lockdown measures that were implemented as a result of everything that happened in 2020. And so in the future, if they aren't able to maintain that revenue stream, that growth, and continue to produce content that attracts the number of members that they were able to bring into their business in 2020, then that could obviously impact their bottom line and their top line negatively in the future. Next page I want to look at is page 24, and we can see right here that they have their results from their business operations separated by their different sources of revenue. And as I said before, their streaming revenues, mainly just the membership services that they bring in for people subscribing to Netflix. That's their primary source of revenue. That's pretty much almost 100% of their revenue. And we can see that in 2020, the revenue they brought in was about $24.7 billion from streaming, and then about $239 million from their DVD revenues. Right here we can see that their paid memberships at the end of 2020 came out to be about 203 million paid memberships, and the amount of memberships that they added in 2020 was about 36 million. They make about, on average, $10.91 per membership for their Netflix streaming services. Then on page 25, we can see their revenues broken up by geography. So we can see that in the United States, that's where most of their revenues come from, but they also have a pretty diversified stream of revenues from not only the United States and Canada, but also from Europe, Middle East, Africa, Latin America, and then also Asia Pacific. We can see that they had about $11.4 billion in revenues from the United States and Canada in 2020. They had about $7.7 billion in Europe, Middle East, and Africa, about $3.1 billion in Latin America in 2020, and then about $2.3 billion of revenue from Asia Pacific. Next page that I want to look at is page 30. And we can see right here, this is just a quick little summary of their cash flow statement, which we'll look at in more detail in a moment. But right here, I thought this was pretty interesting because we can see that even though they had a positive net income for years 2018 and 2019, the net cash provided by their operating activities was actually negative. And there's a reason for this, which they go into detail on page 32. And we can see right here, they point out that they acquire, license, and produce content, and also the payment terms for the content that they license and acquire comes from upfront cash payments relative to amortization expenses. And basically what this means is that whenever Netflix acquires a new show to put onto their platform, they are paying cash upfront in order to get that show onto their platform. And so that's why their cash flows from operating activities is negative for 2018 and 2019, because they are acquiring shows and that's a cash outflow, but the actual amortization expenses, which are basically depreciation expenses, but for intangible assets, those expenses are incurred over an extended period of time. And so when we see that on the income statement, it shows that each year their net income is positive, but because the cash flow statement only takes into consideration the actual cash inflows and cash outflows of the business, it doesn't really take into consideration the amortization at the same date that there is a cash outflow for the business. And so that's why there is a net cash used in 2018 and 2019 as opposed to a net cash provided by operating activities. So that was just something that I thought was pretty interesting. Don't really see that too much with different financial statements. Then right here we have their consolidated statement of operations, otherwise known as their income statement. And we can see that, as we pointed out before, $24.9 billion in revenue for 2020, up from $20 billion in 2019, up from $15.7 billion in 2018. Operating income came out to be a little over $4.5 billion, and then net income was about $2.7 billion, with their basic earnings per share coming out to $6.26 per share. Then for page 46, we can see that this is their consolidated statement of cash flows. And right here we can see this is where they basically add back the amortization of content assets, as I said before, because that's not actually like a cash inflow or outflow. It's something that gets depreciated over time off of the intangible asset on the income statement, but the cash flow statement only takes into consideration cash inflows and outflows. And so that's what leads to the cash outflow for years 2018 and 2019, and then the cash inflow for year 2020. Cash flows from investing activities mainly came from purchases of property and equipment. And then we can see that they brought in a lot of money from raising debt for their financing activities in 2018 and 2019. And that was how they were able to finance their business, since they had a net cash used in operating activities as opposed to a net cash provided. We can see that at the end of the year, their cash and cash equivalents and restricted cash for 2018 came out to be about $3.8 billion, 2019 $5 billion, and then 2020 was about $8.2 billion. So they are experiencing an increase in their cash reserves as a result of raising debt, as well as in 2020 from their cash provided by their operating activities. Then on page 47, we have their balance sheet. And this basically just gives us a quick little snapshot of the financial health of their business on December 31st, 2019, and then also on December 31st, 2020. And we can see that their total assets increased from about $33 billion to $39 billion. Total liabilities at 2020, December 31st, were sitting at about $28 billion, up from $26 billion in 2019. Retained earnings increased from about $4.8 billion to $7.5 billion in 2020, and then their total stockholders' equity increased from about $7.5 billion to $11 billion in 2020. So they are definitely expanding their business and growing economically speaking. And lastly, on page 48, we see their consolidated statement of stockholders' equity. And we can see that the increase in their stockholders' equity came from their net income, which contributed to their retained earnings. So the amount of earnings that they're just retaining year over year, it increased from about $4.8 billion in 2019 up to $7.5 billion in 2020. And then that's what contributed to the increase in total stockholders' equity for the most part. Then next page I want to look at is page 52, and we can see their revenues and memberships divvied up by region: United States and Canada, Europe, Latin America, Asia Pacific, like I said before, but this is just like a more condensed version of it, so feel free to pause the video to get a better look at it. And then the last page that I want to look at before we go into the discounted cash flow analysis is page 66, and this just shows us a little financial review of what their business brought in per quarter in 2019 and 2020. So we can see that in 2020, their biggest year in terms of revenue was, well, not their biggest year, but their biggest quarter in terms of revenue was the final quarter, the fourth quarter, where they brought in $6.6 billion worth of revenue. And then for their net income, they experienced the greatest amount of net income in the third quarter at about $789 million. So the last thing that I want to do in this video is just do a discounted cash flow analysis using this model that I built in Microsoft Excel. And in order to do that, I'm going to use a couple of assumptions, like the potential growth rate for the next 10 years, as well as look at some of the financial metrics that are currently on the business at the start of our analysis, like the cash flow for the first year of our analysis, as well as how much debt is currently sitting on their business. And so for the growth rate for years 1 through 5, I got that value simply by looking at the analysis tab in Yahoo Finance. And we can see that that came out to be about 42.16%. And then for the growth rate for years 6 through 10, I'm just going to be conservative and say that their growth rate will slow down to about a half. But we could play around with this value afterwards to see what the intrinsic value would be based on a higher growth rate. For year 1 free cash flow, I got that from TradingView just by going to the cash flow section for Netflix, and we can see that came out in 2020 to be about $1.9 billion. For net cash minus net debt, we can see that in the balance sheet or the statistics tab in Yahoo Finance, which shows that their total cash came out to be about $7.53 billion and total debt was about $18.01 billion. So they do have more debt on their balance sheet than positive cash. Stock ticker NFLX, and then shares outstanding was about 442.95 million shares. And after we plug in those values, we can see that the present value of the future cash flows, which is all of these values added together, was about $123 billion. Intrinsic value after we take away the debt that's on their business at the start of the analysis was about $112 billion. And after we divide that value by the amount of shares outstanding, we see that the intrinsic value per share based on these current growth rates comes out to be about $254 per share, which relative to the current share price would put Netflix at a pretty heavy overvaluation, considering they're currently trading at about $515 per share. But let's say we were to hypothetically increase the growth rate for years 6 through 10 to remain constant for years 1 through 5. we can see that that would increase the intrinsic value per share to about $537 per share, which would put Netflix at an undervaluation based on the current share price. But I think that a growth rate of about 50% year over year for the next decade is a little bit generous in my opinion. But obviously, with a model like this, there are going to be different assumptions that each investor uses based on their own calculations and the own information they have access to them. So I definitely encourage everybody watching this video to do their own due diligence and come up with their own metrics if they're going to be doing an analysis like this. But in the event that the growth rate did not remain constant and it did slow down for years 6 or 10, as businesses typically do when they get bigger, the intrinsic value per share at the moment seems to put Netflix at a bit of an overvaluation. But I would definitely love to know what everybody watching this video thinks about Netflix from a value investing perspective. Is it trading at a decent price to buy in right now or not? It's currently trading at about 50 times earnings, so that is a little bit high, but for tech stocks, it could be manageable depending on the future growth rate of the business. Let me know in the comments section down below. Like, subscribe to the channel, all that good stuff, and I'll see everybody in the next video.